What in the hell is reflation?
I don't even know what that means.
No one knows what it means, but it's provocative.
No, it's not. It's
Gets
gross.
the people going.
Welcome to Pirates of Finance. On this week's episode, we're going to talk about the reflation trade. Let's start off with some definitions. Inflation means you have a general rise in prices. Usually inflation is trending higher, but if prices are trending down and they're still above zero, that's called disinflation. If it breaks below zero and goes negative, then we have a deflationary environment. The idea of a reflation trade is when the government is both trying to stimulate the economy, both on the monetary side as well as the government using fiscal spending as well, and they're trying to reinflate the economy and trying to grow both the economy and subsequently the inflation rate or rise in prices at the same time.
Uncle Scrooge, why don't they just print up a few billion or so?
A few billion? Oh dear, no. By that word billion, how it's abused.
Now, if that results in the rising inflation of prices, but doesn't result in an economic expansion, that's what we call stagflation. The other component to the reflation trade is we're typically looking for a globally coordinated effort, meaning we have the global economies rising, we have the level of prices or inflation rising, and typically that's going to result in a weaker US dollar. Now, what Corey and I really want to explore about the reflation trade is the idea in reflation or in inflation, a rise in the general prices can have very pernicious effects on your portfolio, and it makes it very difficult to have proper portfolio construction to maintain your purchase power parity as these prices are increasing. So we're going to look at the different baskets of trades that you want to put on for a reflation trade, and then we'll also examine what if the reflation trade is incorrect? How do you hedge out those risks as well? Now, before we get started, I'm going to need you to smash that like button, subscribe, and share it amongst all your friends. As portfolio managers, Corey and I are very privileged to have access to a lot of sell-side research that comes out of investment banks and other hedge funds. We thought the reflation trade would be a great time to share some of these think pieces with you. The reflation trade, by definition, comes from a combination of monetary and fiscal policy. Economic growth should result in an increase in GDP. Coronavirus obviously led to a massive shock to GDP, but according to the SocGen GDP forecast for the United States, there's been a rapid recovery due to monetary stimulus that has brought the economy, or GDP forecast, back on track faster than was previously expected. Personal consumption has been normalizing and increasing. We saw a pickup during the first round of stimulus checks, and JP Morgan is expecting another spike in consumption resulting from the next round of stimulus checks. At the same time, disposable income took a hit during the lockdowns and has been recovering since, and JP Morgan is expecting disposable income to exceed pre-COVID levels after the next round of stimulus checks and the economic normalization resulting from the vaccine rollouts. Spending on real goods around the world has rebounded since the crisis, while spending on services has not recovered. This is based on the policy of mandatory shutdowns and travel restrictions, not on actual demand. That leads us to the question, do consumers have more to spend? The SocGen data shows that US households, as an example, have an excess of household savings of $1.9 trillion. And this is only measured through the end of Q3 of 2020. If this amount were released back into the economy, it would represent a stimulatory impulse of 8.6% of GDP. JP Morgan is showing that the US consumer is flush with cash due to the rolling stimulus checks. Total savings and deposits are up almost 8-fold since prior to the pandemic. And once again, this is before the next round of impending stimulus checks. Retail sales in most of the world economies have rebounded. The question then becomes, with the high amount of savings due to the stimulus, does this create a spike in retail sales moving forward, or do consumers continue to hold their savings? The most interesting piece has been the wealth effect driven by inflation and asset values. This has made the owners of financial assets feel wealthier. In the great financial crisis of 2008, real estate and stocks were underwater for years. We saw dips in the stocks and real estate markets for a brief period during 2020, but they quickly recovered and have exploded to new highs, creating a substantial wealth effect for asset holders. Now we want to look at the inputs from the commercial producer side. The Bloomberg Commodity Spot Index shows that cost of goods took a hit during the initial pandemic fears, but quickly recovered by Q3 of 2020, and has since gone on to increase over 25% beyond pre-pandemic levels, creating an obvious rise in our commodity prices that are inputs to commercial producers. The PMI survey is the Purchasing Managers Index. It's a measure of the prevailing direction of trends in manufacturing. Movements can provide useful insights for business decision makers, and it's typically a leading indicator of overall economic activity. The PMI is suggesting price inflation in both manufacturing output prices and in the input costs of services. Monetary policy has been pro-inflationary and a primary catalyst for the reflation trade.
But unless something's behind it, in the Treasury, something solid and secure, like me, we'd have inflation.
Inflation?
Given that the data seems supportive of a reflationary regime, a natural question is, how should we position our portfolios? There's really three trades getting most of the press. First, with economic expansion and monetary policy being more tolerant of inflation, there's expectation for a steepening yield curve. Steepening occurs when longer-dated Treasury yields rise faster than shorter-dated yields. For example, if the 10-year rate is going up faster than the 2-year, the yield curve is steepening. Why does steepening occur? There are several potential reasons. First, if investors expect higher inflation in the future, they will likely demand a higher nominal yield on their bonds so that their real yield, which is nominal yield minus inflation, remains at an attractive level. Secondly, we would generally expect interest rates to move with growth expectations. If expected growth rates are significantly higher than interest rates, corporations will simply issue a lot of debt to cheaply fuel their growth. Similarly, if growth rates are much lower than interest rates, companies won't issue any debt. This change in supply will impact the market clearing yield level. So with growth expectations going up, so should interest rates. Finally, there may just be less demand for longer-dated bonds among investors who believe that equities may fare better in a high-growth, high-inflation environment, and less demand means lower prices and therefore higher yields. But all of this is very well-established theory, so is the trade already priced into the market? In this graph from SocGen, we can see that positioning for this trade among investors is near multi-decade highs. The red line in this graph measures the net positioning of traders who are long short-term bonds and short long-term bonds trying to capture the spread. This data suggests that institutions are well positioned in anticipation of further steepening. One may even argue that this positioning helped lead to the accelerated sell-off in bonds in recent weeks. This chart from Nomura plots the aggregate positioning for commodity trading advisors and managed futures strategies and demonstrates how they unwound their long position in Treasury futures and rapidly moved into significant short positions over the last few months. This systematic flow, based mostly upon price trends, demonstrates how pro-cyclical unwinds can occur in the market. This does not mean the yield curve will not continue to steepen. After all, prior steepenings took place over many years, not weeks or months. But it may suggest that flows and institutional repositioning may not serve as a catalyst for further moves in the short term. If you do expect further steepening, one simple trade is to simply reduce your duration exposure by moving from longer dated to shorter dated bonds. Within a reflationary regime, there's an expectation for more cyclical sectors to outperform. We can see in this graph from JP Morgan that during rising rate environments, defensive sectors are often left behind in favor of cyclical sectors. Another way of expressing this trade is by going long value stocks. Not only does value overlap in sector composition, but it also currently captures the so-called reopening trade that is made up of a large number of brick-and-mortar service businesses that have been disproportionately affected by COVID lockdowns. While growth sectors like technology benefited from the rapid shift to a work-from-home environment, markets may have been overly pessimistic in their outlook for more traditional or smaller businesses that saw earnings dramatically drop. But again, we must ask, is this trade priced in? We can see in this graph from Goldman Sachs that the value spread between growth and value stocks has meaningfully contracted in the last several months, suggesting that a rapid repricing of value stocks has already begun to occur. This echoes repositioning we're beginning to see in ETF flows. In the following chart, the top graph captures cumulative flows into the energy, consumer discretionary, and financial sectors, while the bottom graph captures the cumulative flows into the technology, consumer staples, and healthcare sectors. We can see that the former has been seeing inflows, while the latter has been seeing outflows, suggesting that investors are repositioning their portfolios for this cyclical trade. A potential further catalyst for this trade may be price momentum strategies, where cyclical sectors are turning into relative winners and sectors like healthcare and technology are turning into relative losers. While the total dollars in pure momentum strategies may be limited, momentum is a common factor not only in multi-factor quant strategies, but also as a catalyst within many discretionary portfolios. Furthermore, growing momentum behind this trade can become pro-cyclical, as price return invites media attention, which can excite investors and drive further flows, which can help further support price returns. Finally, it's worth considering that while flows have already accelerated into this trade, overall positioning in several of these sectors remains muted. In this graph from JP Morgan, we can see that allocations to the energy sector among both active and passive funds has dramatically dwindled over the last several years. Now consider that JP Morgan estimates that there's approximately $1 trillion in equity long-short quant funds. As momentum turns positive for energy, these funds will have to close their shorts and introduce longs, inviting potentially tens of billions of dollars of buying pressure. Finally, with greater inflationary pressures, there's an expectation for commodity prices to increase, and some are even calling for a commodity supercycle boom.
I love gold!
In a recent weekly think piece, Verdad demonstrated that from 1970 through 2020, commodities had one of the highest sensitivities to inflation, potentially making it a great hedge. While we've already seen spot commodity prices climb, both JP Morgan and SocGen go beyond simply calling for outperformance during a reflationary regime. They both call for a commodity supercycle. This call is driven by post-pandemic recovery,
de-escalating trade wars, loose monetary and fiscal policy, increasing tolerance for inflation, a weaker US dollar, a policy emphasis on infrastructure, unintended consequences of environmental policy,
and financial flows that will strive to chase momentum and hedge inflation.
While one way to play this trade is to buy passive exposure to a commodity index, an investor could also gain exposure through commodity-focused CTAs. But as we can see in this chart, even a broad CTA index, which will include funds that trade not only commodities, but also currencies, rates, and equities, should offer a strong degree of correlation to commodities during a strong commodity bull run. While a diversified CTA strategy may not provide pure commodity exposure, it may provide an interesting means to tie all these trades together. For example, positioning in CTAs today suggests that they are currently long commodities and short bonds. Their diversified universe also allows them to be long commodity-linked country indices and currencies. Jason, we just went through a bunch of data, a bunch of different trades. What's your take?
So this week, Janet Yellen and Jerome Powell, everybody keeps quoting them as saying this impulse is transitory or transient. I'm kind of in agreement with them, or I see their point. Typically for that global reflation trade, we would see a lot of data points, and some disconfirming data points we're seeing is the silver to gold ratio. Silver is not really taking off against gold, which would be a signifier of industrials taking off around the world. We're also, German bunds haven't really moved much. I'm started to a little bit this week, but part of that is also signaling that we're not seeing a lot of economic growth out of Europe, Asia, or the emerging markets, which that would signify that synchronized global growth that we would see in a reflation trade, which makes me hint that this could possibly just be some transitory or transient weakness in the dollar. I think about it from a portfolio manager's, position. We like to make holistic portfolios that can handle any economic environment. So if we were to see inflation or reflation, we believe in holding a portion of your portfolio in commodity trend advisors and trend following, that you can ride the wave of those commodity prices rising. And because they're uncorrelated, it just makes for a better portfolio overall from a risk or reward scenario. What was your takeaway, Corey?
Well, a couple of things that have been sort of top of mind for me is looking towards history. And one of the things we saw in the last steepening cycle, which was sort of 2013 through 2015, was that tech was still a leader. We didn't see the cyclicals emerge. Now, that wasn't really a steepening after a true recessionary environment, so this time may be different. But I don't think we have to go that far to history to see that we don't necessarily have to believe that all these trades have to play out the same way every time. On the other hand, it does seem like this momentum impulse is certainly going to happen. We're going to see the momentum baskets start to sell out of tech and healthcare, and they're going to be buyers of energy and consumer discretionary. And so that cash flow is certainly, if it hasn't already started, is going to start happening over the next 2 or 3 months. And that's going to be a big driver of flows into these reopening type baskets. On the other hand, we just saw the stimulus bill get passed this week. Checks are coming out potentially as early as this weekend. And a recent Deutsche Bank survey suggests that retail traders are going to put up to 50% of that money into the market. And retail baskets right now are very sort of disruptive tech company heavy. And that might serve as sort of a counterweight to what's happening in these institutional momentum flows. One of the things I look at as a portfolio manager is trying to not maybe be so black and white. This isn't to me an either or trade. One of the things I actually went back and looked at was, well, what happens if you took both sides of this trade simultaneously as a barbell? If you bought something like 50% NASDAQ and 50% small caps, and you blended them together and compared it versus the S&P 500. And I will tell you, I was incredibly impressed at how resilient a trade it was over the last 20 years. I think sort of the final point I'll say is going back to a note you went over, which was the wealth effect with investors. One of the things that is top of mind for me is recognizing that a lot of the excess savings that consumers have right now might be tied up in the market. So as economies reopen and we see more spending in the services sector, that actually might invite outflows from the market. So ironically, a reopening could lead to weakening equity flows, which could be actually bad for markets. So that's a little strange. And that's it for us this week, everyone. We hope you enjoyed. If you did, please hit the like button, please hit subscribe, and we'll see you next week.